Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China's bank cash injection. Bloomberg has learned that Beijing is considering pumping up to 1 trillion yuan into the biggest state banks. More support for the world's second largest economy. Shares in Asia surge, with tech stocks driving the regional benchmark to a 2-year high. A gauge of Chinese shares in Hong Kong up for a 10th consecutive day. That's its longest winning streak in more than 6 years. Plus, the US, Europe and Arab powers push for a 3-week ceasefire between Israel and Hezbollah as they look to prevent a wider conflict. It's a day when there are two key catalysts for these markets. More stimulus coming through, more support coming through from Chinese policymakers, and then the tech story being revived by the results and the outlook coming through from Micron. Certainly that is lifting the tech stocks in Asia, as we've said, and we will break that story down for you. European futures then on the front foot right now after some modest losses yesterday. European stocks looking to gain around 0.6%. The FTSE 100 looking to add 24 points. S&P futures pointing higher by 0.5. Bit of a divergent picture by the end of the play on Wall Street yesterday, with the Nasdaq up and the S&P down, but only modestly. Currently, S&P futures, as I said, pointing to gains of around 27 points. Nasdaq futures also on the front foot, looking to add 182 points. And the strength coming through from Micron, very much focused on the demand for its AI chips. Let's flip the board and look cross-asset then. Currently, not a lot of movement in terms of treasuries, but you did see the 2-year yield flirting with that 350 level, currently at 355. Softer dollar is part of the trade as well today. The Bloomberg dollar index down. That is giving a lift to some of these other regional currencies. The pound at 133, up 0.1%. Some lines crossing from Megan Green of the BOE, calling again for caution in terms of the approach and the movement from the Bank of England. Brent at 72.91, down 0.7% in the session on oil. Gold still at around those record levels, up 0.1% so far in the session at 2,659. Let's cross over right now to Markets Live. Executive Editor Mark Cudmore for analysis on the market moves of the day. Let's start with the China piece then, Mark. What is your expectation? What's your view on what we've been hearing? Further support for the banks, liquidity injection for the banks, potentially. That's the reporting. What is your sense right now, Mark, of whether or not a floor has been put under these Chinese markets, whether these gains can be sustained, and what the implications are for that economy?
I think these gains can absolutely be sustained. I think what we saw earlier this week was a major turning point in the story. I think if you want to take the cynic's view of today's announcement, look, the situation in China has always been there's been a lack of demand for that kind of loans. Supply isn't the issue. Therefore, this capital injection to the banks doesn't make a big difference. They're already well capitalized. But I think that's the wrong way to look at this. I think the point is that they're continuing to add measures, having already given a massive cocktail of stimulus for almost every sector this week. They are trying to generate animal spirits. They're really targeting the equity market, which I think is really, really important. But they're not just targeting the equity market. They're really targeting the equity market, but they're doing the support of providing things for the consumer, for M&A, for the property market, for mortgage rates, for almost every single aspect. They're providing some marginal help, and they are saying we are going to get markets higher. Already this week, we have seen equity markets getting close to $1 trillion of extra wealth added for Chinese markets. We've seen over $300 billion in wealth added in bond markets. The Chinese consumer is going to be going to the long holidays next week feeling happier and healthier than they were only a week ago, significantly so. And I think that will generate its own momentum. So yes, I think that overall we've seen a turning point this week. Even if today's announcement in isolation might seem a little bit marginal, you shouldn't look at it in isolation.
OK, a turning point for Chinese markets with the CSI 300, the benchmark, of course, on the mainland, currently up 0.9%, to your point. Mark, when it comes to the tech trade, Asian tech stocks getting a lift. We'll see if that carries through to European similars as well in terms of the tech play. Micron coming out with a forecast very bullish. The AI demand still seems to be there. To what extent is that going to be a catalyst more broadly for global markets?
I think it's really important. So from a macro level, it's still extremely bullish for stock markets out there. We've got okay global growth. We've still got okay US growth despite all the panic about slowdown. Atlanta GDP now, Fed indicator, is targeting about 3% for this quarter. So growth is doing okay. Meanwhile, we've got central banks desperate to ease. So monetary situation is good. Financial conditions are still supportive. Earnings are still good. Energy prices are cheap. It's an incredibly bullish environment from the macro level. Now, the problem is, from the micro level, US stocks are extremely expensive. Valuations are already pricing in a wonderful world, and we're also worried at some point of the AI euphoria run out of steam. And I think Micron is another message that, hey, from the micro level as well, you don't worry just yet. And I think that means this bull market continues on again into year end. I don't think that US markets are at the forefront of gains from here on because of the election, because they've already priced in all the rate support and they're already pricing in very exuberantly. But I think global markets continue to do extraordinarily well into year end. And we've put off the worry about the AI bubble collapsing for another few months at least.
OK, Bloomberg Markets Live executive editor Mark Cudmore with a fantastic deep dive in terms of the market reaction to some of these key themes in the trading day today, of course, including the tech story, Micron, and more details in terms of the policy response from China. We will get you more analysis on the China piece to that as well in the next couple of minutes out of Hong Kong. But for now, let's give you a taste of what is in and on the agenda here in the UK and across the world as well to be focused on today. 7 a.m. UK time, we're going to get H&M earnings. So an interesting gauge in terms of the consumer and that exposure to retail in that environment of a more challenged consumer. To what extent is H&M holding up? A touch point then on the consumer in the UK and across Europe as well. That's at 7 a.m. UK time. We'll break that for you. 8:30 a.m. UK time. This is a really fascinating one on a central bank front. It's the SNB of Switzerland, of course. That rate decision fully expected to cut, but by how much remains a question, as inflation is around target, but growth is challenged in Switzerland. So that is going to be crucial. We'll break that for you, of course, and it's going to be the last decision by Thomas Jordan, who heads up the SNB, before handing over the baton. And at 1:30 p.m. UK time, we're going to get a gauge on the labour market of the US with US jobless claims. The initial jobless claims is a weekly print, of course, but we know increasingly FOMC officials are switching their focus from inflation to the labour market of the US, and that's why that data point is particularly consequential at this moment in time. Now, Bloomberg has learned that China is considering injecting up to 142 billion US dollars of capital into its biggest state banks. Back to the details on this crucial story right now. The potential move comes after Beijing unveiled broad reductions, of course, to key policy and mortgage rates to revive that economy. So how should we interpret, how should the markets interpret this potential move? Another big stimulus shot or a sign that China's banks are now distressed, given the heavy lift they've had to do to support this economy, to take on, of course, those cheaper loans and those cheaper mortgages. Let's bring in Bloomberg's Min Low, standing by in Hong Kong. Min, what do you take from this latest news, this potential proposal, this potential liquidity injection, the first time since 2008 for China's banks?
That's right. It's very significant. First time since that global financial crisis in 2008. And it comes at a time when banks' profit margins have been at record low of 1.5% as of end June. That's below the threshold of 1.8% that is deemed as necessary for reasonable profit. And we have seen time and again that the banks have been asked to do national service for the economy, right? To cut mortgage rates, cut lending rates, to provide dividends at a time, to shore up the stock market. Those mortgage rate cuts was estimated to save homeowners some 150 billion yuan in annual interest payments. That's money that is no longer going to the banks. And we heard the PBOC governor on Tuesday promising that all of these monetary stimulus is going to come at a neutral impact on banks' profit margins. So perhaps this release in cash injection is going some way to stabilize that, but also quite nuanced here, because we also know that these banks actually, when it comes to their capital adequacy ratio, it's well above the 8% requirement for systematically important banks. So they actually don't need that capital injection technically in order to continue their operations day to day. So our Bloomberg intelligence analyst is saying maybe this is a signal that the PBOC is going to guide the banks to take on more credit risks, to lend more to perhaps distressed property developers or the cash-strapped local government financing vehicles to give a boost to the economy. And if they need to take on more credit risk, then these banks will need to bolster their balance sheet to protect against the chance of an increasing amount of non-performing loans.
OK, so maybe preparing the banks for further action to support that economy. Meanwhile, it seems like officials are finally heeding the warnings, the calls from economists and analysts out there, indeed former members of the PBOC, saying you need to get cash into the hands of China's consumer. Is that what we're seeing now? Is that part of the plan in terms of giving money to some of the poorest in that country?
Yes, state TV had announced that the government is now going to give direct cash handout to the extremely poor. There are about 4.7 million of them. We don't know the size of that handout, but it is pretty significant. It's a departure from the past where we know President Xi has traditionally been very resistant to the sort of welfarism that Chinese officials have said could encourage laziness. So this comes perhaps, with the state of the economy as it is now. Maybe it's making the government reconsider this move to provide direct cash handout. They're supposed to give this out before the start of that Golden Week holiday next week, typically a time of peak travel and spending. But of course, with the extremely poor, maybe they're not going to go on a holiday, but perhaps it still can give a boost to those essential items, the household appliances, the consumer staples. That has been a group of stocks that's one of the worst performing sectors in China so far this year. And by the way, it's the 75th anniversary of the founding of the PRC. So state media saying this is a sign that the government and the party are showing its love and care for the citizens as well, Tom.
Oh, we love a bit of love and care from the CCP. Thank you very much. Bloomberg's Min Min Lo in Hong Kong. Now, switching focus, a 3-week ceasefire between Israel and Hezbollah has been put forward by the US, Europe and Arab nations in an effort to prevent all-out war. Hezbollah is yet to comment on the proposal, while Israel's ambassador to the UN says a diplomatic solution is preferable.
I would like to see a ceasefire and the return home of Israelis to the homes in the north and southern Lebanese to their homes in southern Lebanon. That's what we all want to achieve. It will happen either after a war or before a war. We hope it will be before.
OK, Bloomberg Horizons anchor Jemana Pasechi joins me now for what we've been hearing, both from Lebanon officials there, but also as we've been hearing from the Israeli side. Where do things stand? What has the response been to this potential 3-week ceasefire?
Yeah, well, yesterday when we were talking about this, there was a perception that the next 24 hours are going to be key for the direction of what happens on the ongoing war and the airstrikes in Lebanon. And of course, this proposal came through yesterday. It was sponsored by US, several EU leaders, Arab countries as well, Saudi Arabia, Qatar, Egypt, all signing on to the language around the ceasefire proposal, saying that it is time to conclude a diplomatic settlement that enables civilians of both sides of the border to return to their homes in safety. Now, we just heard from the Israeli ambassador to the UN. He said that they are open to the possibility of a ceasefire. And earlier today, I had the opportunity to speak with the Lebanese economy minister, and he said that it would be very welcome. They would like to see a ceasefire, of course, and that he has had discussions with Hezbollah, and they seem to have shown some flexibility in the last 24 hours vis-a-vis a potential truce with Israel. So perhaps some more positive signs coming from the language and the rhetoric from both sides. But of course, the death toll continues to climb. The Lebanese health minister has said that in total, the death toll is now sitting at 636 since the airstrike started on Monday, with more than 2,000 people wounded. And 5,000 have been admitted to hospitals since things have really started to escalate in the last week or so.
So the toll on the human level is very much there. And you're talking about the fact you've been talking to a minister from Lebanon's government. So give us a bit more flavour in terms of what he has been saying about the impact on the ground.
Yeah, well, the backdrop to all of this is even before the war started, Lebanon's economy was in a state of decline. It saw a massive economic deterioration over the course of the last couple of years, huge levels of inflation. The currency is devalued more than 90%. 50% of the population are living below the poverty line. And that was the starting point. You add a war to that. You add the fact that you've got, per the Lebanese foreign minister, hundreds of thousands of people internally displaced, and it is putting a lot of pressure on the country's infrastructure, economy, and things like sourcing key materials that are necessary, things like food, wheat, medical supplies, supplies for babies and families. Let's listen to what the economy minister had to say.
The economy is in a very bad place. This war has added a layer of challenge to Lebanon. In 2023, we were hoping, we had expectations of growth. We had hopes that certain sectors, including tourism and food industries, will flourish. All that has gone. All that has disappeared. Growth is non-existent at this point.
Growth is non-existent at this point, he says. Again, and even this was the state it was in before the war started. Later on in the interview, he said that they have enough supplies to cover the country's needs for the next 4 to 6 months, which really underscores the importance of this proposal, the ceasefire proposal that has come through, because it would provide temporary relief, at least, for the Lebanese economy.
OK, 50% of people below the poverty line before the escalation in these tensions and this conflict. Jemana Pasechi, thank you very much indeed with the context around the story that is continuing to unfold, of course, in that region, our Horizons anchor. Let's get back to the China story right now, because some lines breaking on the terminal. This is a redhead on your Bloomberg terminal. China striving to complete its annual economic goals. The Politburo, so the gathering of the most senior members of the Communist Party, has been meeting, and we've been waiting for this. The annual economic goals of China, of course, by the end of this year are for growth of around 5%. Up until a few weeks ago, you had many of the Wall Street banks cutting their forecasts, and Bloomberg Economics, for the growth picture for China. The expectation was they would miss that target. That was before, of course, the announcements around stimulus that have come through this week. And now the Politburo stepping up on that front, saying they will strive to complete those annual economic goals. That remains crucial for this Politburo, and that explains a lot of the stimulus that comes through. The stimulus is very much targeted at making sure they get to that growth target. The Politburo is stressing they will make efforts to boost the capital markets as well. They will support M&A of listed companies. We'll bring you more details when we have it. Coming up, Donald Trump lashes out at Volodymyr Zelenskiy for not striking a deal to end the war in Ukraine. We have the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, former President Donald Trump has lashed out at Ukraine's Zelenskiy for criticising him and for refusing to make a deal, as he characterises it, to end the conflict with Russia. For more on this, our EMEA News Director Ros Matheson joins me with the details. Ros, what do we know? This is significant. Zelensky had been hoping to meet with Trump on this visit. Trump then lashing out. Why?
Yeah, well, of course, this is not good news for Zelensky, because he was very much hoping to meet Donald Trump on this visit. They've had a very troubled, long history, as we know, but the prospect of Donald Trump in the White House come next year means that they need to have some kind of rapport, at least a relationship. And so he was hoping for that meeting while he was there. But Donald Trump has now criticised him for making a pit stop at a Pennsylvania weapons factory. He's saying that's a swing state. It was obviously a partisan move during the US election. He's saying that it was favourable for the Democrats, and also because Zelensky's been criticising Trump, he says, in turn for his comments about the war. So it's all gotten very messy very quickly, and the wheels have kind of fallen off the hopes for this meeting as a result. And so now, of course, Zelensky is meeting Joe Biden, but they've got an established, very warm relationship. He's meeting Kamala Harris, of course, the Democrat contender, who he doesn't really have a relationship with, and that's important too. But, of course, you know, the setback for him is that come next year, if it's Donald Trump in the White House, what does that mean for future arms sales, you know, deliveries of weapons and other aid, financial aid to Ukraine? Is it all off?
And is it spreading beyond Trump and J.D. Vance and their criticism of Ukraine to broader parts and broader swathes of the Republican Party, where there has been some strong support? It's pretty divided on Ukraine, but there has been some noticeable support for Zelensky. And to what has there been the reception to his peace plan?
Well, that's exactly right. I mean, some senior Republicans have been very ardent supporters of Ukraine, in fact, pushing the US to do more to support Ukraine. But this seems to have really upset them, this visit to this factory, and what it was designed to do is unclear, but what it's done, obviously, is upset them all. And again, that means when it comes to things like congressional support for Ukraine, and that's really important to get some of these packages through. There's only so much the president can do themselves through their own power. And so congressional support is important, and that might be fading depending on the makeup of Congress come next year as well. And so really, you know, this is difficult for Zelenskiy. He's going around the US talking about a victory plan. And it's at this point, a lot of allies are saying it's not really a moment for victory. You're going to have to negotiate.
OK, Ros Madsen, thank you very much indeed with the context around the story of Ukraine, Zelenskyy's visit to the US and the challenges. The EMEA news director, of course, for Bloomberg, Ros Madsen, with the context. Coming up, economists forecast a quarter-point cut from the SNB today. It's a particularly interesting decision for the Central Bank of Switzerland. Could they be wrong in terms of the forecast like they were about the Fed? The economists, at least, were wrong, not the traders. We discuss the possibility of a Swiss surprise. That is next. This is Bloomberg. Welcome back. Now, could we be in for a Swiss surprise? Economists expect a 25 basis point cut from the SNB, but some are speculating that the central bank could follow in the footsteps of the Fed with a bumper reduction. Bloomberg's Bastian Benrath-Wright joins us from Zurich as we count down to this decision. A lot of expectation, a lot of excitement, Bastian, quite frankly, when it comes to the SNB. You don't get to say that every month. What are the pros and cons, then, of the options on the table for this Swiss National Bank?
Well, yeah, I mean, like, it is actually true. We could be in for a Swiss surprise. Like, if they just do what everybody says, then, like, this will be a day like any other, rate decision like any other from the SNB. But, in fact, like, what we have to keep in mind is that the rates in Switzerland are lower than almost anywhere else. So they have to preserve firepower. And since the economy is not doing all too bad, different from like other European markets like Germany, for example, Switzerland is doing actually quite fine. And so they could also opt for a hold, which would be really a big surprise. And then on the other side, they could also follow the Fed and do a 50 basis point cut. Because on the other hand, they also have a little bit the problem that inflation might undershoot, actually. The Swiss National Bank has an inflation target between 0 and 2%. They have this range they want to keep inflation in. And the inflation forecasts for next year look very low. So actually, some people are worried that inflation might go too low. And so they also could go big. And since the SNB doesn't give any forward guidance, it's really wide open. And yes, we could be in for a Swiss surprise.
Yeah, all right. And it's also the last rate decision by Thomas Jordan, the chair, of course, of the SNB. Is that likely to play into the decision making?
Honestly, not really. Like, obviously, you could think of like Mark Carney, who left the BOE with a 50 basis point cut, which nobody had seen coming. So if you want to see a parallel there, it could happen like this. But honestly, Thomas Jordan is actually not the kind of guy for that. I talked to a well-known economist here in Zurich, and he was like, nah, he's just going to look at the facts, like just proving your point, like going for your ego. That wouldn't be Swiss. So if you ask me, I wouldn't say it plays into that a lot.
OK, it wouldn't be a Swiss move. All right, Thomas Jordan is, of course, very Swiss. Bloomberg's Bastian Benrath-Wright in Zurich on the countdown to what could be a really exciting, what is already proving to be a very exciting SNB decision. Thomas, thanks, Sebastian. Thank you very much indeed for the context. Later today, we're going to hear, of course, from the incoming Swiss National Bank President, Martin Schlegel, on that rate decision and his plans before he takes up his role next week. That is certainly an interview you want to tune in for. Coming up, how does Europe compete in the generative AI revolution? Our exclusive conversation with the founder of a venture capital firm backing the sector. That is next. This is Bloomberg. morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China's Politburo says it will implement what it calls forceful interest rate cuts and necessary fiscal spending as it looks to further ramp up support for the economy. Shares in Asia surge, with tech stocks driving the regional benchmark to a 2-year high. A gauge of Chinese shares in Hong Kong up for a 10th consecutive day, its longest winning streak in more than 6 years. Plus, the US, Europe and Arab powers push for a 3-week ceasefire between Israel and Hezbollah as they look to prevent a wider conflict. So China once again stealing a march on these markets. It is not one and done from the policymakers in Beijing. The Politburo doubling down on the policy measures already announced by the PBOC. And here's the important piece on fiscal support. That's what the economists and analysts have been looking for after the PBOC came through with a flurry of significant measures earlier this week. The fiscal support will be there, says the Politburo. Of course, a gathering of the most senior leaders in China. They will do and ensure necessary fiscal spending. Of course, we'll be looking for the details on what that fiscal spending means, but we've also had reports that they're handing cash to some of the poorest ahead of the national holiday and, of course, mulling a potential liquidity injection into the state banks to the tune of £1 trillion, or around £1 trillion, exactly, around 140 billion US dollars. They will look to stabilise the real estate market. That's the Politburo stressing that they will implement forceful interest rate cuts. Chinese markets then rallying once again. The CSI 300, the benchmark, up 2.5%. Currently looking to post gains so far year to date when it had been on track for another 4 straight year of losses. Over in Hong Kong, the HSI jumping 3%. The HS Tech Index, of course, with that heavy tilt to the tech industry, currently up 5.5%, storming in terms of the gains coming through for the HS Tech. And broadly across the Asian session, then the MSCI Asia Pacific up 1.7%. All of this feeding in to upside on the futures when it comes to Europe, currently looking to gain around 0.8%. Tech is also part of the story because Micron surged in late trading after AI demand bolstered its sales and profit forecasts. And Asian markets, of course, getting a lift on the back of that, particularly around some of those chip makers. The read across around AI is there. But how does Europe compete in that Gen AI revolution, and what is holding the region back? Bloomberg's Oliver Crook in Berlin with a guest who can walk us through how to think about the Gen AI stack, how to position, and how Europe can boost its competitiveness on technology. Ollie.
Yeah, Tom, thank you so much. Listen, we got the Draghi report a couple of weeks ago. It was long awaited, and it basically serves as the animating document for the new European Commission. It amounts to a formula for how to boost European competitiveness, and failure to do so, he says, will guarantee a slow agony for the European continent. One of the things that he points to is the fact that Europe has not founded a single company in the last 50 years that has a market cap that exceeds $100 billion. As you can see on your screen, every single one of the ones in the United States that exceed $1 trillion in market cap were founded in the last 50 years. So how do you build the companies of the futures? You need the startups of today. So here to help us sort of appraise the landscape of the startup industry here in Europe and try to fix it potentially is Hendrik Brandis. He is the partner and co-founder of Earlybird Venture Capital. So Hendrik, thank you so much for joining us this morning. How do you bring European tech into the 21st century here?
At the end, you know, it takes 4 elements to create large cap and significant technology companies. It starts with the talent, it goes over the culture, where you need respective technology, and you need capital. And I think that is the predicament we face in Europe. We simply do not invest sufficient capital in growth. And this is exactly what Draghi says, and he's 100% right. I mean, if you just take Germany, we invested in 2023 just 7 billion in growth companies. I mean, the real number, if I even compare that what we had back in the, during the phase of the first Wirtschaftswunder, we've been at, in our prices, in the area of 100 to 150 billion annually. So we are a factor 10 to 20 away from where we need to be in order to be competitive in that dimension.
So how do you change that? How do you lift those hurdles? How do you get that money that you need injected into the sector?
I think the only way is to actually mobilize private money. And it's not so that we do not have the capital in principle. Alone, the German insurance industry is investing 300 billion annually, and it goes predominantly into government bonds. It goes in Greek and German and French and what have you, government bonds, because in the first place, Solvency II foresees zero equity backup for government bond investments. Whatever you do as an institutional investor in growth capital, you have to back up with 100% equity. And obviously, that is not going to work. So if we find ways to redirect that private money into where we like it to have to be in growth, that would definitely solve the problem. So we won't be able to change Solvency II overnight because there are too many countries involved, but we can probably use the credit worthiness of public, of the government, of Germany, of Europe, in order to reduce the formal risk and to bring that capital into the sector.
And so we'll try to be a little bit optimistic, as you have to be in your vocation. So what are some of the sort of ingredients, the virtues that exist within European tech, the skills, the talent, the universities that can be leveraged in order to have a successful tech sector here?
I mean, we're not lacking the science, we are not lacking the talent, we are not lacking the technology. We see so many impressive companies and technologies being invented and started here, but we're missing out on the last mile. When something is emerging, it's getting it's getting traction. People from other institutions, from other regions of the world, identify those, provide the capital, and attract them into their region.
And we have a fairly concrete example of that happening with one of your investments, Marvel Fusion.
Yeah, Marvel Fusion is coming out today with good news, though, that they were able to raise their Series B, and it is a very disruptive nuclear fusion company. However, there's also a larger piece of public funding involved, and that public funding is predominantly coming from the US, with the fact that the demonstrator, which is not going to be built in Europe, where I would love to have it, it's going to be in Colorado, because that obviously
because the Department of Energy was willing to put
to
the money that the
provide
Europeans
significant
were
money,
not
and said,
able to raise
but
here.
you know, there's little prerequisite, it needs to be in Colorado instead of Europe.
Right.
And obviously, the company had the choice to either do not build the demonstrator or go to the US, and the choice is obvious.
And in terms of the question of AI, which is considered to be kind of one of the large growth drivers over the next couple of years, maybe decades, where do you see sort of Europe standing? Do you think that maybe this AI story is potentially a little bit overhyped?
I think short term it is overhyped, but in mid and long term it's not overhyped. It will change the world, but it's like with the internet. Initially, we expected the changes to come quicker than they actually did, but it will come, and the same I think applies to AI.
Hendrik, Brandis, thank you so much for joining us this morning for your sort of appraisal of the European tech landscape, how to get it more competitive in a moment where, as Mario Draghi warns, the European continent really is at risk of permanently falling behind. I'll hand it back to you, Tom.
Yeah, it's a crucial conundrum, isn't it, for Europe's tech sector, the growth piece and the scaling. Oliver Crook, thank you very much indeed on the ground for us in Berlin with that interview. More breaking lines coming through right now, and this is around the German chemicals giant. Talking of Germany, the German chemicals giant, of course, with that global exposure, BASF. Year to date, the stock is flat. Coming out with lines right now in terms of a return of cash to shareholders. BASF saying it aims to return at least 12 billion euros to holders from 2025 to 2028. That is via dividends and share buybacks, targeting around 12 billion euros. This is a stock for you to watch then at the open, 8 a.m. UK time. The redheads crossing, the breaking lines crossing on your Bloomberg terminal. Again, year to date, the stock is essentially flat. We'll see if this juices the upside for BASF, which of course has challenged and faces challenges around the energy input and gas, and of course the supply chain conundrum as well, but looking to return more cash to shareholders. Coming up, tech stocks and more China stimulus drive Asian shares higher. We're going to discuss the global market outlook with Janet Mui from RBC Brewin Dolphin. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Now, Asian markets have hit a 2-year high on the back of surging tech stocks and more stimulus from China. Let's discuss the wider outlook then with Janet Moore, head of market analysis at RBC Brewin Dolphin. Thanks for joining us in the studio, Janet. So we've had the lines crossing from the Politburo. They've doubled down, they say, on their support around interest rate cuts, but also the fiscal stimulus as well. We're waiting for the details on that, but we know that was the key part of the ingredient that economists were saying was missing from the monetary policy, the significant monetary policy support that was announced earlier this week. So my question to you is, how do you play the China story right now?
Hi, Tom. Thanks for having me. I do think that the stimulus package has been quite comprehensive, and I think it shows determination that the Chinese authority wants to support the economy and stock market and property market, which is all in the right direction. So I do believe that there could be still near-term momentum for the stock market rally in China, given how cheap it is and how sentiment has been very depressed and the positioning has been very weak there. So I wouldn't rule a further rally in the Chinese stock market. But for us, I think there's still question marks regarding the sustainability of the rally because I think, as you say, the details on the fiscal side is still missing. And also, I think for the boost to the stock market, a lot is via leverage. The aim is to lend money to non-bank financial institutions is actually to buy the stock side. So I think that could increase actually the risk further down the road in terms of the leverage in the system. And I think there's still concerns on the inflation side of things is still very weak, the momentum. And in that environment, it is difficult to see how there would be a lot of credit demand coming through. So we need to see more of that coming through. And of course, at the end of the day, corporate earnings results, it is still likely to remain quite depressed. So I think how we can play is, I think in terms of the stocks in Europe that are sensitive to Chinese growth, say the luxury sector, I think there are some opportunities emerging because some of these large luxury stocks, they have been trading at quite depressed multiples, and there could be opportunity to get a better entry point into those stocks.
Okay, so the window is still open to get exposure to European luxury on the back of the China story. That is potentially one way to play this then for you. Talk to us about more broadly the central bank cutting cycle that we're starting to see, at least in terms of the ECB, the Fed and the BOE. How supportive will that be? Markets pricing at about 74 basis points from the Federal Reserve, so that would include, given that we just have 2 meetings left, a 50 basis point cut. Does that seem reasonable to you? Is that going to be supportive, or is it indicative of a slowing and weakening US economy?
It does. On the surface, it does look quite excessive. They have already done 0.5 percentage point rate cut, and if there's another one, it does seem that they're in an urgency to cut rates quite sharply. Which I think, there is a risk that...
Would that change your... If they came through with another 50 basis points, would that question your bullish call on US stocks?
I think it depends on the communication, really, and I think Jay Powell handled that really well last time. Because if you look at where the Fed funds rate is, even after the 50 basis point cut, if you compare it to, say, where core PCE inflation is, it still shows that financial conditions are quite tight at the moment. There's still certainly a scope to cut rates further. It depends on how quickly they do it. So I would say it depends on the communication, whether they're arguing that the rate cut is really due to subdued inflation pressure and really the fact that they want to ensure that there's no recession coming. I think if they want to support the economy, that's obviously a great thing for financial market.
You're overweight US stocks. Which segments of the US stock market do you favour at this point? Is the rotation play part of the thesis then? Rolling out a mega cap tech into, for example, the Russell 2000, the small caps of the US?
Well, we're still, I think the core of what we like is still quality growth at this stage. I would say the risk is more balanced nowadays. We do see potential for a broadening of the equity market rally. I think all depends on the resilience of the U.S. consumers. The thing is, we do see some weakening in the labor market and U.S. consumer spending. So we are a bit cautious on that outlook. We still like the big mega cap technology stocks because we see that as a quality growth area that is really tapped into AI and semiconductor stocks, that theme, which we think is both cyclical and secular. So for the broadening of the equity market, we're still closely watching this space.
Okay, the curve steepener trade has been popular amongst PIMCO and BlackRock this year and others. Does that have further to run, or do you want to cash in on those steepener trades?
I think it is difficult to say, to be honest. I think, as I mentioned, I think quite a lot of rate cuts have already been priced in on the front end. And I think for the longer end, I think it could be dependent on who is going to be in the White House. Because, for example, if Donald Trump is in the White House, it could be more inflationary. At least the market would perceive that as more inflationary in the longer term as well. So I think the next events that could determine this would be the results of the U.S. election.
Okay, so maybe politics taking a run on federal or at least the Federal Reserve machinations and next move. Maybe it's the politics that take front and centre stage when it comes to how we think about the yield curve of the U.S. Janet Moore, thank you very much indeed from RBC Brew at Dolphin. With still that overweight call on U.S. stocks, U.S. equities and UK as well, interestingly, but with a focus on quality, at least for now. Now to our scoop on OpenAI. Bloomberg has learned that the company behind ChatGPT is weighing giving CEO Sam Altman a 7% equity stake. Let's bring in our tech reporter Annabelle Drulers in Hong Kong. Annabelle, how big a shift is this then for the team at OpenAI that had been, of course, a non-profit?
It's extremely significant, Tom. I mean, you can't really understate this. Just speaking about this possible equity stake for Sam Altman, I mean, he's someone himself who has been on record. I mean, he was even as recently as last year on a Bloomberg panel saying that the only reason he would ever want a stake would be so people could stop asking him about why he should have a stake. He's been very clear in the past that he didn't want to have any sort of ownership of the business because of its non-for-profit structure, and it was there to serve sort of the greater good, to benefit society. Now it seems like that has shifted somewhat, and again, what we're hearing from sources is it could be a 7% stake. To put it in context as well, and as you said, alluding to that non-for-profit structure, that's exactly how OpenAI was established back in 2015. Of course, it started to generate a lot of investor interest, some funding. AI tools are extremely expensive to power and to develop. So they established a for-profit subsidiary that sat beneath the umbrella non-for-profit structure in 2019. That led to some tension, and it sort of culminated last year, or was flared up last year when we saw Sam Altman being ousted, possibly around that exact point. It does seem now, though, that they're going to do a corporate restructuring and have that for-profit structure sitting right at the very top.
OK, so a really significant structural change coming through for OpenAI, potentially. As we talk about AI, we have a reminder that the demand for some of the components around Gen AI is not going away, at least if we look at the results and the outlook coming through from Micron. Very strong, particularly around the high bandwidth memory part. Are we right to be thinking that there's a read across to the broader market here? How is it impacting Asian stocks? How should we be thinking about this as an indicator of that demand, Annabelle?
Well, exactly as you say, it tells us that even though we had those concerns a couple of weeks back around NVIDIA, perhaps it was maybe not drying up, but a little bit sort of unsubstantiated how much investor fever we were seeing around AI. It certainly looks like it's going to be set to continue because the latest earnings from Micron have come in really solid. So we've got that guidance for the upcoming quarter, and they're seeing revenue of about $8.7 billion. Now, the average analyst estimate had been 8.2 rather, or 8.3. So it's quite a big jump from 8.3 to 8.7. Earnings per share also sent to be about 20 cents better than expected, so $1.74 versus projections of $1.52. What we got in the quarter just ended, again, it was a 93% jump in revenue. And as you say, Micron's been a really big beneficiary of this demand for so-called HBM chips, high bandwidth memory. They're really critical to powering AI tools, and Micron, again, gaining from that. So as you say, yes, that broader sentiment shift or lift, you can see here some of the big Asian chip makers today, and we are seeing some very, very solid gains.
OK, great stuff. Bloomberg's Annabelle Drulers breaking down the tech stories for us with a focus on OpenAI and the results and the outlook coming through from Micron. Very strong indeed. Thank you, Annabelle. Staying on technology, Meta has debuted its first pair of augmented reality glasses called Orion. The prototype has lenses that can display text messages or video onto the user's field of vision. Meta's chief technology officer says he expects the glasses will become a consumer product within the next decade.
I think we're more than 1 year away, less than 10 years away, but we have a very clear line of sight to a consumer product. The price isn't clear to us yet. One of the big things going from a prototype like this is understanding what can we learn that allows us to simplify, or what do we need to keep in future designs, and that's going to control where the price lands. But we really want to get this into a price point, a form factor that not just consumers use it, but developers want to build for it.
All right, plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the S&P notched a 41st record high earlier this week. Bit of profit taking coming through yesterday. Futures pointing higher today. China is part of the mix. The valuation gap, though, the premium that you are paying for exposure to the S&P versus the rest of the world right now, that spread is at a record high. The yellow line representing the spread at 7.95. You can see it more visually here with the S&P versus the global index when it comes to global equities. Look at that gap that's opened up then, and that is the premium. That is the valuation gap. Some would say, look, this is justified given the rate cuts coming through from the Fed, given that some of those mega cap, the Mag 7, sit within the US equity space and not in Europe, certainly not in China. So that's justified. Others would say, maybe this is a vulnerability for the records that keep being churned out by the S&P. At some point, there will be a reckoning, could be the take from some. Let's flip the board and have a look at what's happening in terms of the moves as well into the front end of the yield curve and how that's diverged from expectations around inflation in the US. This is really interesting because most of the time you can see this correlation. This is the blue line is the moves into the 2-year at the front end. The white line is representing a 1-year push-out view on inflation coming through from the markets. And you can see that crocodile-shaped gap that's opened up now. So the view coming through that you push out 1 year, inflation getting back up to around 2%. That's in line, of course, with the Fed's target. But at the same time, we've seen more money moving into the front end with the 2-year at one point flirting with 350. The last time I checked, it was around 355. Markets, of course, pricing in around 74 basis points of additional cuts from the Fed by the end of this year, which would include that 50 basis point cut as well. So that is interesting and may signal on the inflation expectations an expectation that this soft landing will be achieved. Well, the data on the GDP front is going to be interesting today. It's the third revision for the second quarter GDP print coming out today out of the US, expected to come in at around 2.9%. So on an annualized basis, still pretty solid. And interesting, the Atlanta Fed Now gauge and tracker of GDP is currently sitting at around 3%. You can see how it's edged up, in fact, just in the month of September, now sitting around 3%. We'll see what that GDP print speaks to later today. Jobless claims as well. We know, as of course, FOMC officials increasingly focus on the labour market. That data will also be important. Bloomberg Terminal users, of course, can get access to these charts and others used throughout the show at GTV Go on the Bloomberg Terminal. Coming up, it's the opening trade. We speak exclusively with former ECB President Jean-Claude Trichet. Do they need to go again, the ECB, in October? Stay with us. This is Bloomberg.